Welcome everybody back to our next webinar here at JFD Brokers, and a warm welcome in the name of JFD Brokers as well, but also from my end. And speaking right now is Stefan Friedrichowski. Yeah, as you know me now, I think, and we get more and more used to each other. It's really good to have you here once again, back to that kind of webinar. And for the records, I have to mention the date. Yeah, we have the 30th of May and 7 p.m. 2017. Wow, that year went on extremely fast, at least for my feeling. But anyhow, so that's not the topic of today. Today, the topic is all about power candles. That's a special thing we want to investigate. So, as always, it's not only just presenting another trading strategy. You know me now a little bit more that if I talk about trading setups, trading opportunities, I always like to emphasize how I come to those kind of conclusions. So, what's behind what I'm talking about? And is there anything I can present and show you which really draws exactly those kind of conclusions? And that is something we want to do as always. You might already have realized that in the GoToWebinar control panel, you find already the slides of today. And later you will see I will present something special. And then latest, you need my email address because I cannot share this MT4 indicator I want to present here today. I cannot share it directly out of the GoToWebinar control panel simply because of the data formats of that technical tool. So anyhow, just send me an email, but that is something for later. Good. I've always to show shortly this slide because we talk about trading strategies. So keep in mind that whenever you trade, you do it on your own. But I know that you know that quite well, and you understand even why I have to show every time this slide. Talking about slide, just one additional remark here. You always find the recordings of those webinars and also from my other colleagues on the YouTube channel of JFD. So just link that YouTube channel to you. Maybe you follow directly, then you get notification whenever there's something new. Anyhow, there are brilliant webinars of those colleagues as well. And even in English, you find something there as well. Good. So, but back to the topic. So, today I want to dig a little bit more into the overall topic of developing trading strategies because it's a good point in time to show you a little bit more of how I think and how I derive all those strategies I personally follow. So meaning not following in the sense of follow other traders. No, so those trading setups are real trading setups for my own. And so that you understand a little bit more how I develop trading strategies at all. During the next couple of weeks, months, and so on, I will always dig a little bit deeper into that topic. So it's a brief introduction today, but you will see that will have a follow-up even on that more general point of view. Especially next webinar, for example, will be a little bit more about statistics. It always sounds boring, I know, but it's quite helpful to get those trading strategies. I want to share with you directly then one example, and that example of today is power candles. Candles which are more big, more pronounced than any other candles. And if those power candles occur, that has a special meaning. And that not only a special meaning by its own. No, it has what we call a probability advantage, an edge for our trading activities. And of course, that's what we want finally to have, is not only something special, what happens sometimes in the market. It's quite more important to have an idea of how can I trade that and why it's good to trade exactly what I will present. And that can be derived just once again with a short Excel sheet, and you will learn how to do that. Finally, I want to present an indicator, a so-called MT4 indicator for power candles. That means I can show you how to use that indicator, and it will automatically highlight special candles within the chart whenever a power candle occurs. And so that gives you, let's call it a signal within the chart. Hey, now it's time to have a closer look. And thanks to Peter Milner, who has coded that indicator, I can share that indicator with you as well. Finally, then you, as announced, you will need my email address, and then I can send you the indicator directly via email. Good. So I want to start a little bit more about how to create trading strategies at all. And maybe it's new or astonishing for you itself that my starting point is, as yours, just the observation in the chart. So, of course, I look to charts, and of course, I go through different underlyings, different time frames, and so on. And from time to time, I do or I make some observations. Why do I call that abstract? Because I mean it exactly that way. That means, just an example. Let's look for the DAX index. Maybe you have the observation, hey, between 9 and 10, if the DAX within that time frame goes upwards, that is a good indicator for the rest of the day. That's now a hypothesis, nothing else. So that's not proven. But you look to the chart and see, okay, today it was exactly that way. I have no idea whether it's really today or whether that observation would fit or not. It's just an example. And you look for the day before, yes, confirmed. Even the day before, no, it doesn't work. Last week. And you find some examples, sometimes it works, sometimes not. But you think in the majority, it seems to work. Having the observation, the first hour of the DAX gives you a good indication for the rest of the day. So finally, out of that observation, we have a hypothesis. And now what we need is we need a statistical proof of that idea, of that basic observation. And if we can prove and if we can confirm that we have a probability advantage with our idea, with our observation, or more trading like this is called an edge, a wording which is sometimes more related to poker, but anyhow, it's valid here as well. So if we can confirm that edge, then this is the start of a new trading strategy, a new trading setup. What to do? We need this statistical proof, and not only just looking to the chart a few days backwards or maybe 1 or 2 weeks backwards. No, we need much more data, and in order to confirm or not confirm our idea, but we need real statistics. What I don't want to see is just a confirmation like, okay, 3 times it works, 2 times not. That's an edge. Fine enough. I will trade it from tomorrow onwards. So that's quite too short-handed. No, we need a real proof, and we can derive those proofs sometimes just with Excel, and I will show you a little bit more about that. Finally, we have to do one additional step, and that step is that we then finally need exact trading rules, because just knowing, I come back to my example, just knowing, okay, we consider the first hour of the DAX between 9 and 10, and that gives a good hint for the rest of the day. That's still not a trade. A trade is much more. Trade needs an entry criteria, and what's most important, personally for me, is we need a stop loss, for example. But let's go through the list. So we need a clear defined entry criteria for our trade. And of course, the next is we need a clear exit criteria. So back to the DAX example, should we close a trade at 5:30 or at 10 o'clock, or should we apply a take profit or a time stop or a trailing stop or whatever? So we need definitely a clear defined exit criteria for our trade. So when to close a trade. What we need additionally is always a methodology to calculate our position size. In whatever way you are doing that, maybe you use 1% of your account as a rule of thumb or whatever, but we need a rule for that, because only if we have a stop loss and a clear defined position size, then we really know what we are doing. Finally, as mentioned, we need a stop loss for all our trades. Otherwise, we have an uncalculated risk, and that's nothing I would do with my private money. A take profit is not automatically needed, so we can live with a stop loss only, and we don't need a take profit. Why? Because we have that exit criteria. As long as we have a clear defined exit criteria, then we don't need to take profit. It might belong to our specific strategy to have a take profit, but it's not necessary. At least if we have an exit criteria. Think about trading strategies like crossing an EMA. So, for example, that strategy, you have an open position and you don't have take profit, but you will close that position whenever the price crosses the EMA or vice versa. So that means we have an exit criteria, but not a take profit. So just more from a logical point of view, the more needed one is the exit criteria. So, but all what we have to do here is that first is a statistical proof. And for that statistical proof, what we need is price data. We need historical price data for our observations. And normally, or at least from my experience, the price of the history you can have within MT4, for me personally, is too short. I'm in most cases looking for more than 10 years, even on smaller time frames. So what I need is historical price data. Yeah, and the best is, as always, for free. That I don't have to pay for those kind of data, and therefore, and I know that a lot of people have similar ideas like I have, but finally, what they need is price data. Therefore, I mention here 4 sources for historical data. All 4 sources are free. Only the latter one here, you have at least once to register, but don't worry, you don't get advertisements or any other news via email. So it's only a registration, but you don't have to pay for that. So let's go through the list. So the first one is Yahoo Finance, because there you can have a lot of D1, so daily based data, and you will find mainly indices, and if that is of interest for you as well, you will find ETFs there as well, but D1 and not intraday data. The maybe most comprehensive source is what is called stock.com. And be sure that it's not a spelling error here. It's really written that way. It might have to do because that website is based in Poland, and maybe they write stocks that funny. Anyhow, you find there are really hundreds and thousands of underlyings, so nearly everything you can download there. With extremely long histories. So if you think, for example, about Dow Jones, you can have the Dow Jones from the very beginning, 1800 something. So and even the gold price goes back to 17. I forgot, but so we have really long histories for those data. Next source, and now we go intraday as well, is a source which is called histdata.com. Here you will find M1 data, so on a minute base, mainly for Forex, a few indices and a few commodities. Be aware that those data are New York time. So if you look for the DAX, for example, it opens at really strange timing. But you will see that. So anyhow, you have access to M1 data for about 8 years now. And the last source I want to mention here is Dukascopy. Here you can even go down to tick data and everything upwards, of course, simply by a selection of the time frame, then your private time zone, and so on. And then you will find currencies, indices, commodities, stocks, so everything you need. And then you can do analysis like I will do in the next couple of minutes with the power candles. So because I will do my example on H1, and even H1 means for 10 years history, that is about 70,000 rows of data. So that's already quite huge, but that gives us a good statistic for what we are doing and for our analysis, and finally to prove or not prove any hypothesis of a trading setup. So those sources, and if you have problems with them, just send me an email. I can help you if you don't know how to convert or how to import those data in Excel, for example. It's quite easy, but if there's a problem, just send me a note. So that about data sources, and that is something we need for our trading strategies as well. But now back to the overall topic, power candles. So the basic idea is that sometimes there are huge candles. But now back, what does it mean if I talk about a huge candle? Because if I talk about a huge candle, I always mean the body of a candle. And just to remind you what's the difference, let's quickly go to a chart and zoom a little bit in. So here, for example, we have where now my cursor is in the left upper corner, a little bit bigger green candle, so a bull candle. And the body of a candle is always the difference between close, which would be here, and open, which is here. Let me look whether I can find another example just to see only a huge candle, but let's look for this one, where now my cursor is. Even that candle is not that small, but only between high and low. The body of that candle is not that huge. So if I talk about power candles, I always talk about the body of a candle. Go a little bit further down the line, the road, then you might know those dojis, which more or less don't have a body, and they only have the two lines upwards and downwards. So that is a signal of uncertainty and exactly the opposite of what we are looking for right now here. So one thing we could do, and I will, within the next couple of webinars, I will do something similar. For example, we can look for the distribution of the candle size. Of course, you might think the bigger the candle, the less often. Okay, you're right. The bigger the candle, then it's more seldom, less often that you will find those kind of candles. And if you do the real analysis of that, then you will find that that distribution more or less follows a so-called Gaussian distribution. So size versus occurrence probability is a Gaussian distribution. But now comes the but. There's a big but within that distribution. And what you will find is that big candles still occur too often. So normally, so those tails, and you really talk about the tails of a distribution, those tails are a little bit too much pronounced. So you will find big candles a little bit too often. Or in a more common sense, those are black swan events. So, and they occur too often. So, and that is that they are not according to the typical Gaussian distribution, which would be a proof for the total randomness of our prices. That deviation of that randomness is our chance. That's our chance being a trader. You know that most of the times the prices are just wiggling around, and you're always on the wrong side. You enter a long trade, price goes down, and so on and so on. You know those kind of stories, I assume, quite well. But we have from time to time deviations of that randomness, and those deviations are exactly those power candles. And therefore, because they are too often compared to a random behavior, that nearly automatically gives us a chance as a trader. And you will see that we can even derive more out of that, because we will see how to trade such a power candle. But still, a little bit back to why those candles occur. In most cases, they are driven by news. And news with whatever specific reasons. There might be news like EZB interest rate decisions, or Fed interest rate decisions, or every second Friday non-farmers payroll, or so news you know exactly before that the news will happen. But there are other news which really come all of a sudden, sometimes really bad news like terror attacks or something like that. And since a couple of months, we have a new source of news. Since the time we have a new US president, you know that this president, Mr. Trump, from time to time twitters, and you have there's a strong relationship with Trump twittering and big candles within our charts. So that is something new since a couple of months now, but that is one additional source for news. So news, not always, but in quite frequently create power candles. But the good thing about power candles is that the big market participants, so the real big money, and I'm now not talking about our trades as being private traders, maybe trading zero point zero 0.01 lot, maybe trading zero point 0.1 lot, maybe even trading 1 lot, or even 10 lots. That's still nothing. So I'm now talking about the real big money. Um, when you have to place orders with thousands of lots. Those big money, big market participants, they reveal their real interests about prices on the forex market or on other markets. So you will see, along with power candles, normally the volume goes up. And since those big players, they have to maneuver really big amounts of money, they cannot do everything within a few milliseconds. That's not possible. You cannot place an order of 10,000 lots, and that would really ruin the price. So you have to do it stepwise. But now the market is already into one direction. So you have follow-up actions of those big market participants as well. And that is a little bit of the story behind power candles and why they work. So in principle, we are talking about exactly this one here. So here's an example. Here is one that's H1 data from Euro, US dollar. It's already a long time ago. If I see the price, it's 1.35. So that chart is not that fresh. But anyhow, it's just for illustration purpose. You see here a big candle. And the question behind is simply, is there a typical behavior in time and price after the occurrence of a power candle? So you see, I have drawn two lines here, two red lines, and the question is that maybe something quite typically? And overall, you see that the price goes into the direction of the power candle. So is that something we can use for trading? And the answer is simply yes. But what we need is we need something like a minimum size for such a candle. So what is a power candle? Is it from 10 bips or 40 bips or 100 bips or whatever, depending on the time frame, of course. But so we need criteria. So is there a minimum size for such a candle to be labeled being a power candle? And both things we can answer a little bit already with a simple Excel sheet. And let me show what I have done here. So since I don't want to bore you a little bit too much here with Excel details, but briefly how that Excel sheet is created. Starting on the left side here, you see just the prices, open, high, low, close, on an H1 base. So finally, that are about of 70,000 rows here. Then I simply calculate the body size here in real numbers, so not percentage. Just the difference between close and open. And then I compare that size, but the absolute value without the sign, with a threshold, a limit. It's now in German here. Schwelle. Schwelle means limit or threshold. So in this case, it's 40 bips. Whenever this candle on the left is bigger than 40 bips, then a 1 would occur here. Let me show you at least one example. Here we are. There we have an example. That candle is bigger than 40 bips, and then a 1 pops up here. And what I do then, whenever I have a 1, so meaning I have a power candle, I look to the right and calculate for the future the movement. Let me highlight what's here. So I look to the difference to one candle in the future compared with the close of that power candle. So I know now the movement after 1 hour. Next to the right, I calculate the movement after 2 hours, after 3 hours, and so on and so forth. And I've done the analysis here in that Excel sheet until 24 hours. And now what I have done additionally is I multiply that price difference in the future with the long or short direction. So my hypothesis is that the price goes into the direction of my power candle. So if we have a short candle, so going to the minus, then I multiply everything with -1. So now if I add up summe means sum, I add up all the price movements after 3 hours, after 4 hours, after 6 hours, and so on and so forth. Then I can plot that. And that's exactly what you have within the chart. What does it mean? It means the average movement after 1 hour, 2 hour, 5 hours, and so on and so forth. And now it's getting interesting because everything is calculated with the right sign. So short movements to the short side times -1. Long movement, of course, to the plus side. No need for any correction. Multiplier. It looks like that the overall price movement goes into the direction of my power candle. And there's another number here, which you might have already realized. How often does that event occur? And in this case, it's 3.5%. So around about every 33rd candle is a power candle. Or in other words, since the day has 24 hours, so every second day we have something like at least one power candle. So it's not set that less often, but at least sometimes it occurs. Let me show you what happens if I make that threshold much shorter. So let's go down to 10 bips, 10 bips only. And of course, the number of power candles is extreme now. And we have every third candle is following that. But we don't get that typical behavior. So, but on the other hand, if you go, for example, to 60 pips, doing a little bit higher candles, higher candle sizes, then we once again get the typical picture. How to interpret that picture? It means starting from the close price of the power candle itself, the price goes up, then for the first 7 hours, then it comes back a little bit, but not even to the close. And I emphasize the close of the power candle, not the open. And then for the next 10 hours, it goes up extremely steep. So what we have here is the statistical proof that the hypothesis, whenever a power candle occurs, the price goes into the direction of that candle for the next couple of hours. That's now being proved. And that's good, because now we have that probability advantage, that edge we can use for our trading activities. And just to illustrate that this is quite typical, in this graph I have summarized the average price movements for power candles of 20 bips, 40 bips, 60 bips, 80 bips, and 100 bips. So you see that in the region between 40 and 80 bips, it looks quite well that we have that probability advantage. And that is already enough in order to have successful trades. But the most important thing is you can do the same analysis for other underlyings, and you will find, of course, different number of thresholds, but the overall behavior is quite similar. And going here for H1 candles, the main reason is to have really good statistics. You might imagine that if I do the same on D1 base and looking back for the last 10 years, for example, then it's only 2,500 candles at all. Now 1% is 25. So if I would have the same percentage, like here, 1% of all my candles would um, um, exceed the threshold, then it's only 25 candles. So that statistic is not that good. But for H1, I have already lots of data, 80,000 rows here, and therefore I can really argue that this is now statistically proved. Knowing that, we can already derive some first rules. And what we know. So we know now that there is a probability advantage after a power candle, in the sense that whenever a power candle occurs, so exceeding a certain threshold, then the price follows the direction of that candle. So you can think of a big train has started into one direction due to a news event, due to whatever, and now the train goes on into that direction, not easily being stopped. So it follows the direction of the power candle. If there's a bull candle, big bull candle, price goes additionally upwards. If we have a big short candle, price goes additionally downwards. Of course, you can think about variants of that trading approach. For example, you might look for small corrections before entering a trade. So the analysis within that Excel sheet was done in a way, hey, the trade would have been opened exactly at the close of that candle, or maybe the open of the next candle, which will be close to the close of the previous candle. But anyhow, what you can think is, hey, why not waiting a little bit that there's a correction after the candle first and then opening the trade. So a little bit more like my picture, this one-time statistic picture illustrates. So first of all, the price went down a little bit down and then going upwards once again. So that might be one possible improvement. And there's another reason why I mentioned that. You will not be always in front of your screen when a power candle occurs. You may come back later, 2 hours later, and still seeing that candle, but the game is by far not over. There might be still a good chance for you opening a trade. Another idea to improve that concept is not thinking in bips, in absolute numbers, like I have done within that Excel sheet. A lot of you might remember the financial crisis 2008 up to maybe 2010 or 11, especially when everything was really extremely nervous. You might remember that we have had huge candles in a row. So what does it mean? So in talking about a fixed definition like 40 bips might not be adequate. It might be better to use a comparison, for example, to the overall ATR, to the overall volatility of the market. Just use an ATR indicator to measure the overall volatility of the market. And if that is already extremely high, then the power candle must be even higher or bigger. So think more in terms of a multiple of an ATR as a threshold to label a candle a power candle or not. So that variant, by the way, will be the one we have within that indicator for MT4. So it's a good idea to use the overall volatility as a measure for the candle size and not the candle size itself, because then we don't have any link to specific timings like high volatility markets, low volatility markets, medium volatility markets, and so on. So that might be an additional improvement here as well. As promised, I want to show you one possibility to really trade that power candles via a small tool. And that indicator is coded by Peter Milner, a colleague of mine. He's living in Austria and he's really doing a great job coding all that stuff and even coding expert advisors, for example. And you will see, and first go through the list here, but we'll do it in practice as well, that indicator has a few settings, just a color, okay, but it has an ATR period. So exactly what I mentioned, use an ATR value in order to really measure the size in the right way of a candle. And still you can switch between candle body, as I mentioned during my talk, or you can additionally have a look to the overall high-low differences as well. And the indicators, what does the indicator? Finally, it highlights all power candles fulfilling those kind of criteria. But let's go in practice because then everything is much easier to explain. So let's open a chart, a fresh chart here. Let me fill more or less nearly this complete screen here with that chart. So that's now Euro, US dollar, and now I'm on H1 base. And you think here, hey, what is a power candle? Is there a specific one, yes or no? And now let's do what I sometimes call quick and dirty statistics, like looking to this candle here, now circulating around with my cursor. That would be a short candle within the next couple of hours. Overall, price went further down. Or at the beginning of the chart, having a big candle here, yes, for the next couple of candles, price went up. So hypothesis confirmed by statistics of 2. No, that's just a joke. So that's not how we have done it, how we have derived that setup. You have seen the Excel sheet with 70,000 candles in order to prove or not prove that hypothesis. But anyhow, we can now do the next step and we can use that indicator. And that indicator is here, JFD giant candles. And I simply throw that indicator here on my chart. And now I have the choice with a couple of values. So I need an ATR period. And originally that is has been done for D1 data. For H1 data, I would increase that number. Minimum would be 24. Reason, at least I want to have always a full day in the history of the ATR, so that we have not just the night period, which is normally a low volatility phase. Then we would have more or less always at the beginning of the market power candles, so that would be not a good story. So minimum would be 24 in order to have always a complete day being the history for that ATR. But maybe not 1 day, maybe 2 days, so 48. Then we have that multiplier being the threshold to label a candle power candle. And finally, we can distinguish between body or the overall high-low difference. I personally go always for the body because I don't want to label big dojis being a power candle. So that's all. And now we have a picture here, and we can what you see here. Okay, the color. I should maybe change the colors that you can see it a little bit better, but you will see at the beginning here of the chart, there's one candle exceeding the ATR threshold, and the multiplier of 3 is already incorporated here. So we have one candle exceeding. And now back to the hypothesis. After such a power candle, the market should go on into the direction of the power candle. Okay, proof once again, statistic one. That is not a real statistics, as you know, but at least for this power candle, it has worked fantastically. We can think about other candles. You see already here, very good within that second chart window, always the size of the body of the right candle compared to the overall ATR value. And you see, yeah, of course, there's a difference if I maybe go down the road with an ATR to 24. Still, I would not touch any of those power candles. But for example, let me reduce the multiplier to 2.5. Oh, still not in the range. Okay, I go directly here to 2. Then there will be additional candles being highlighted as being a power candle as well. And you see it doesn't work that bad. So this candle, once again, confirmation of the hypothesis. Next candle, confirmation. This candle, no confirmation, exactly the opposite. So that candle is now labeled being a power candle, but price does the exact differencing. And now back here, yes, confirmed, slightly confirmed, but only more or less a flat movement. And then next confirmation here. And for those two, I cannot foresee the real future. You see, that is short-term statistics, just looking back to a few candles. But of course, the Excel sheet, for example, was done for 10 years history, so a much longer history. But the good thing of the indicator, it helps you to identify those candles. You can play around with the thresholds, the ATR values, and of course, what you can even do is you might change time frame, for example, to M5, but make sure that you change the ATR period here as well. And honestly, I still would go for an ATR period, which would still represent more or less a day, which would mean 288 candles of period, simply because I don't want to follow with the ATR the intraday volatility movements, which are always there. And then you are always behind the market. So that's the problem with that. If you don't have a complete day within the ATR period, then you are always lagging to the ATR behavior. And therefore, I would go at least for higher periods here. Anyhow, that's how to work with that. So you have simply put that indicator here into your file folder, MQL for indicators. So exactly here you have to place that indicator. You can have via email from my end. That is a folder. You have to copy that indicator, and then you can apply that simply by drag and drop to the chart, and you have highlighted directly the power candles within the chart. Good. Let's go back to the slides, but as you might imagine, we come now already to the end. So what we have learned today, lessons learned, power candles. Power candles are the black swans of trading. And that's not a marketing gag or something just to name it that way. Everything is meant real, meant serious. And we can prove it via statistics, just looking back, in this case, for 10 years history of price data. And we can confirm two things. The one I have not done today, but I will do within the next webinars next month, that we have a deviation from randomness, because those kind of candles occur too often compared to a complete random behavior of the markets. And whenever you have that deviation from randomness, it's a trader, the trader's chance. And what we found out here is that there's a preferred direction after the occurrence of a power candle. And the preferred direction of the future price movement is into the direction of the power candle. So if you have a big bull candle, price goes upwards again, and if you have a big bear candle, then price goes down. What you have seen here as well is that thanks to Peter Milner, we have a very nice indicator. You might have interest in that indicator as well, and I can send it around. So that indicator helps us to identify power candles, looking to the real body size of a candle and comparing that size with an ATR, which I think personally is the best way to deal with power candles. So it's a useful tool, and it's a useful overall strategy to look for those black swans within trading. So you know my email address, and you can get in touch with me to get that indicator, or if you want to have additional slides here, Excel sheets, or if you simply have a question to the webinar, or even other questions all around trading. It's always for me a pleasure to have you here within that webinar series. Thanks to JFD, who makes that webinars possible for all of us. And now I wish you all a very good evening. Have a nice time. See you again very soon, and watch out even for the webinars of my colleagues. Very interesting topics you find there as well. See you again, hopefully. Bye-bye.